Hi, my name is Christopher Terry, CEO of iMarkets Live, and in this video we will be discussing margin and leverage of both the Forex market and the futures market. What we're going to do in this video is we're going to look at the Forex spot market, the Forex futures market, and the S&P E-mini futures. So we are going to start with the Forex market. In the United States, we have what's called leverage and margin of 50 to 1. So the Forex spot market has a 50 to 1 leverage. What does that mean? The leverage means how many times more on your cash can you trade. The margin is what the minimum requirement is to trade. There's 3 different lots in the Forex market. I'm going to explain them real quick. So one is the mini lot, or actually micro lot, and this is leveraging $1,000. And you need $20 to leverage $1,000. And I'm going to explain all this in a minute. This is the mini lot, and you are taking $200 and leveraging $10,000. And then 3, you have the standard lot, and you are taking $2,000 and leveraging $100,000. So looking at the USD JPY, for example, anything with the US being the dominant cross, it's based on dollars. If we look at another market, for example, if we look at the EUR-USD, the EUR-USD is a bit different in how it's calculated. The margin is a bit different, whereas in the USD JPY, the USD Canadian, it's all based on dollars, $100,000 for a standard lot. In this case, where the euro is dominant, you're taking that same 100,000, but that's 100,000 units of the EUR USD, the euro. So to buy that, it would cost 122,000. So there is a bit of a difference. So we're going to keep it simple and keep it to start the basic 50 to 1 leverage that everybody talks about, and the margin. So the brokers say for margin, you need to have a certain amount of money before you are required to trade. The micro lot, you need a margin of 20 bucks. The mini lot, you need 200. The standard, you need 2,000. Now, somebody could trade 5 micros. It'll cost you 100. So you can mix and match this. You don't typically normally have to be restricted to 1 mini or 2 minis or 3 minis. You can have, say, 2 minis at 200 each and 3 micros. It's up to the person who's trading. So there's no restriction in that regard. So the broker basically says we need a deposit for you to trade. The same thing as if you were to buy a home. So if you have a home that's worth $100,000, the bank says, give me 10%. Give me $10,000 and you can control a $100,000 home. That's as simple as it is. It's the same thing as putting your margin. So if you're saying, okay, the bank would say, give me a margin of 10%, and then you can have the $100,000 home. It's the same thing. It's a deposit. for you to control a bigger amount, to leverage. So margin is the minimum required to trade, and we would not suggest only trading with $2,000. Typically, you'd want to see 4 to 5 times that. So somebody with $10,000 can trade one standard lot. And some people do it for less. They may say, you know what, I want to do it for 3 times. So I'll put $6,000 up and trade one standard. Some people do it for 4,000. We, being conservative, want to stick with what the standards are in the industry, and we'll say that do a 5-to-1 ratio. So you're looking here at this $2,000 and it leverages 50 times or $100,000. So that is your leverage. Your leverage is 50 times your margin. So that is what margin and leverage means in the Forex market, the Forex spot market. You have in other countries where they have 200, 300, 400, 1,000 times leverage, which means that for $2,000 you could leverage 400 times that or 200 times that. But in the United States, there are laws, and the law is basically limited to 50 times. Outside the United States, it's a completely different world. It's a completely different model. For those of you that are in other countries, you could check with your broker. But you have to remember, leverage cuts like a knife. It could work for you or it can work against you. And the main thing you want to do is always protect your trading account. You don't want to be so leveraged that it causes your account damage. So that is the Forex spot market. Let's go through this again. The Forex spot market, you have a minimum amount of margin, which is similar to a deposit that you would make on a home if you were financing a home. $2,000 controls 100,000. Now let's take a look again at the EUR USD, and we're going to see how the non-dominated US pairs or non-dominated pairs are. For instance, the EUR is the dominant currency, so the price is right here at 1.22. Now it's based on 100,000 units or 100,000 euro. Now what they require is around $3,500 of margin. So you have less margin, less leverage on it. They ask for a little bit more of a margin to control this because of the volatility, right? They know how much the U.S. Currency is, but the euro, the British pound, the other currencies are volatile. So the brokers typically ask for a little bit more. So if you take 100,000 euro times the price, which is 1.22, that's 122,000. Divide that by, say, 2%, right? It's 2,400 bucks. They ask for 3,200, 3,300 as a bit of a cushion. So rather than getting so confused, just keep it at its basics, that it's a 50-to-1. So now we're going to look at the Forex futures market. This is a bit different. The broker, and let me try to find, hold on. Okay, what I did was I pulled up the Ninja Trader brokerage because we trade through Ninja. Ninja was originally just a platform where we execute our signals, and they purchased a broker called Mirrors Futures. So Ninja Trader has become their own broker, and now they are basically doing, it looks like they're trying their best to take over the industry in terms of offering low commission rates and good margins. So, bless them, because we actually utilize them for our signal services. So I want to show you, right? And we are educational partners with them. That's it, nothing else. We have no financial relationship. So let's look at Forex. Okay, we're just going to look at the 6J here, all right? The 6J, we'll look at the euro. So if we look at trading leverage. This is based on equivalent of a standard contract in the Forex market. So where in the Forex market, you need $2,000 to trade a standard, or you need 3,200 to trade a standard. And these numbers change, okay? These numbers change. This is called intraday margin right here. This is if you are holding them less than 24 hours a day. In the futures market, if you hold it where they close for 1 hour, you then have what's called the overnight margin rate. So for instance, let's take the Japanese yen. If you were taking a long-term position in the Japanese yen, something that you would take in the overnight session, which is within 1 hour, the market will open and close, you need to have $2,400 in your account. Now, with that, if you're trading this Japanese yen on a standard amount, which is the big boy, which is what we said to use 10,000 on or such, in the larger standard count for Forex, you would need many times this margin. So if you were trading that big, you would actually have the minimum amount. But for day trading purposes, and we love to use Forex futures for day trading purposes, and there are other reasons why. So at iMarkets Live with our signal, and then we suggest for people that are doing their own trading to use the Forex futures for day trading. It's much better of a market between the spreads and the margins also, believe it or not. So let's take a look here. You can do equivalent in the spot market for half for the Japanese yen. So the spot market, you needed for a standard contract $2,000. In this market, you need 1,000. In the euro, you needed 3,200, and in this market, you needed 500. Now, if we look at the other markets, the same thing, where British pound, you would need 3,500 in the spot market, and 2,000 and 2,000 in the Aussie dollar and the Canadian. So the futures offer you less money as a deposit, and you get the same leverage as you do in the spot market standard. So let's do a little math here. The Japanese yen, for $1,000, you are controlling 100,000 Japanese yen. So you're getting 100 times leverage on your money, on the margin. In the euro, you're for $500, you're leveraging 122,000 at the time of this taping, because we know the euro spot euro futures is around $1.22. So you're always multiplying the euro price times 100,000. So if the euro price was $100.50, it'd be 150,000. So at the time of this taping, and prices will change, it's $500 controls 122,000. That's over 200 times your money in leverage. So United States, the futures market allow you to have much larger leverage than you would in the spot market. So looking at this right here, we would still suggest you have a few times the money in actual account balance. Now, although you're not taking a swing position as you would in the Forex market where you need a wider balance, at least a couple of times, maybe 3 to 5 times is fine. So if you had an account where you were trading the Japanese yen and you had 3,000 or 4,000, that's plenty, because when you're doing scalp trading in the futures market, your risk is very small. So you may risk $50, $100, $75, $200, depending on you, the trader. So you can see that you don't really need many times more leverage as you would in the Forex spot market. But keeping a standard 5-to-1, we typically suggest to day trade, it's good to have around $5,000 in an account. And you could do one contract, even 2 contracts if the market is in your favor. So leverage again, and margin. The margin is the minimum required deposit that you need to trade with. And in the Forex futures market, the minimum requirement is 500 for some of the markets and 1,000 for other markets. The leverage is how many times on your money. For example, a US dominated symbol, which is the Japanese yen, you're getting around 100,000 times your money, 100 times your money, whereas the Forex futures, the euro, you're putting a $500 margin to get $130,000 worth of leverage. So you're getting over 200 times your money. So margin and leverage, same as real estate where you're putting down a deposit on a home to control a lot more. Let's take a look at the S&P E-mini futures. S&P E-mini futures are the next one we're looking at. And while we're on the uh, brokerage margin amount here, so let's take a look at this. To trade the S&P E-mini futures, your margin is $500 during the day, and we only trade it during the day. The initial margin for the 24-hour period, if you were to hold it past a certain time, when the markets close during the day at 4:15 in Eastern time, and you hold it for an hour when the markets close, you need $5,000 in an account. So best to day trade, and this is a favorite product for people to use for day trading, for short-term trading. $500 controls, and I'll get into that right now. Let's take a look at it. All right. Okay. What does $500 control in the futures market? Well, it's 50 times the price of the market. So in this case, it looks like $103,000 that $500 controls. So $500 gives you looks like 400 times your money in leverage. You're controlling a product that's worth or 100, 200 times your money. I'm sorry, 50 times 2,000 is 100 or 103,000 for $500. You're getting 200 times your money to be able to trade. So essentially, that's like putting $500 down on a $100,000 home. This allows you to trade the markets during the course of the day. So margin is $500. Leverage is the amount that it leverages, the amount that you can trade. Now, we do not suggest to put $500 only to trade. We suggest to have an account, $3,500, $5,000 or more. You just want to have enough where you can have some wins and losses and your account doesn't really suffer so much. You just want to be realistic about that and not put a small amount. To trade an account with $500 margin and you put $800, that's a negative. You don't want to do that. You want to have several $1,000s in an account because you're leveraging such a high amount, where the real margin for this is $5,000. Keep that in mind always when you're trading. Just common sense says don't put a low amount against your margin, because any little swing, you basically could just go through the margin amount and not be able to trade. Now, there is people ask, oh, can you lose all of your money in trading? No, the margin is a minimum amount that you can trade with. So if you put, let's just say you have $1,000 in an account and you have a $500 margin, you can't lose more than that $500 technically. So if the market, if your value of your account, you lose 500 bucks, you can't really trade after that. So you cannot lose all your money. It's a buffer. It's a protection for the broker so that you do not go into such a loss that you would cause the broker to lose. So the broker is protecting themselves and saying, put a minimum amount in your account and then you can trade. Now, we at iMarkets Live, we do not look to blow up our accounts, right? We want to be successful, but we also want to be smart. And you want to have, although the accounts say minimum margin is 500, you want several thousand in an account, right? So that's margin and leverage. I went on for 20 minutes explaining this. Watch the video over and over again if you need to. It's really important to understand the power of leverage. It cuts like a knife. It can work for you or work against you, and you always want to keep that in mind. The other thing is the Forex futures market. that we discussed, and I know there's going to be a question on that. For example, this is the Forex futures market. They have one contract that we trade. It's equivalent to a standard contract. The spot market allows you to trade, and this is the USD JPY. Just want to keep this in mind. All right. The spot market allows you to trade smaller. So if you were a person with a little bit of money, you can trade the micro and the mini and then leave the standard when you have more money in your account. So can somebody come in with $500 in trade? Of course. You can use micros and minis. Can somebody trade with $200? Of course. Can somebody trade with 200,000? Of course. So the Forex spot market allows that, the smaller accounts. So those people with smaller accounts, you may not want to trade futures in the beginning. You'd want to trade Forex because of the amount that it allows you. You can trade smaller than standard accounts. Now, are you going to make big money on a small mini account? No, of course not. Will it get you into trading live? Yes. So keep that in mind that when you do trade, when you do trade your money, you also have to be responsible, but also you have to understand that you can use the Forex spot market for littler accounts as well as large accounts, but the futures account, you need a bit more money. Anyway, my name is Christopher Terry. I hope you enjoyed the video, and we'll see you on the next video of Pips and Ticks.